All right, so let's get started. Welcome again, everyone. Good morning, good afternoon to our global audience. Thank you for joining the PowerUp series, Fighting Financial Crime with Unit 21, session number 1, top 3 types of fraud trends, strategy and rules. On the agenda today, we will have some housekeeping notes and opening remarks, and then we will discuss the 2023 top 3 fraud trends that we see among Unit 21 customers, which are mobile check deposit fraud, card not present fraud, money mules, and drop accounts. And we will also have some time for live Q&A. So I definitely encourage you to submit questions, and I will do my best to answer all of them here live at the session. For those of you who are not familiar with me, my name is Alex Pavusovich. I am the head of fraud risk here at Unit 21. I'm a fraud prevention practitioner for the past 15 years, working with many traditional financial institutions, did about 5 years in consulting, eventually transitioned to fintech. In my last position, I was the head of fraud risk for a neobank designed for small businesses and freelancers, where I had the opportunity to go and use Unit 21 for my transaction monitoring needs. So I'm also an ex-customer of Unit 21. I love the product so much, eventually I decided to join the team. Today at Unit 21, I work with our success team, supporting existing customers on their fraud strategies. I work with the go-to-market team in supporting them talking to prospective customers. I work with our product team, and I also work with the marketing team at Unit 21. So overall, I oversee all the fraud and risk practices at the company. Few quick housekeeping items. So this session is recorded, and we will email you the recording after the session is over. It will be emailed to you tomorrow. Like I mentioned earlier, we do have Q&A at the end of the session, so I do encourage you to submit questions, and you can expect me to answer those at the end of the session. For those of you who are existing customers of Unit 21, of course, if you're more comfortable reaching out to your customer success manager with a follow-up question, feel free to do that. For the prospective customers, if you feel more comfortable reaching out to your account executive or point of contact at Unit 21, of course, feel free to do that. But in general, I'm here to answer your questions. So let's get right to it. On today's session, we will talk about the 2023 top trends of fraud that we see among Unit 21 customers. Now, one of the things we try to do at Unit 21 is to see how things are trending on the market. We have a very big mix of customers. You know, we have smaller organizations, we have large enterprise organizations, we have different verticals. Some companies are a more fintech approach, some companies are more crypto approach, some customers are more traditional banking approach. So we try to understand what is really trending, where customers see a lot of fraud instances and how they deal with those fraud instances. We also provide them, of course, ongoing support. So really the goal of this session is to share some education and some insights on what we are seeing among Unit 21 customers. And on today's session, I will discuss about mobile check deposit fraud, card not present fraud, and money mules and drop accounts. So let's get right to it. So mobile check deposit fraud is probably the top concern of what we're seeing on the market today, and especially among our customers. It mostly fueled by, let's say, in the past 18 to 24 months, we see a very high spike of mail theft. And mail theft is pretty much an instance where bad actors will hack a mailbox, break it, or have a master key to open it, and they will steal all the checks from that mailbox. And what they do with those checks is one of two scenarios. They either wash those checks, so basically they will try to wash all the information from the check and then rewrite this check, or they just sell those checks on markets, on illegal markets, which we will touch upon today. But really, if we look at mobile check deposit fraud, it really comes to three different verticals. So we have a very classic first-party fraud, where you will have a user just deposit either stolen or counterfeit check. We have fake employment scams that we're seeing spike lately, and we have just traditional funds funneling. And I will touch on all those three scenarios today and how you can address those scenarios with Unit21. So the first scenario is a classic first-party fraud scenario, where basically you will have a user who probably go to a illegal market, buy a counterfeit check, and will try to deposit. And what we try to do on the deposit side of things, so if we are the institution who receives the check, we will get the image from the SDK, from the vendor who took the image. We would try to understand how is the history of this account been so far? So what is the history of the deposits been so far, whether it's check deposits or whether it's payroll deposits or whether it's ACH or wire activity or any other deposits. We will try to understand if checks are the main source of income or they have a different type of income associated with the account. We want to understand the history of return deposit items. So how good or bad the checks that have been deposited so far on this account look like. We take into consideration account tenure, so how long this person been banking with us. And if we have third-party vendors integrated into Unit21, we ideally want to utilize any insights we can get from a third-party vendor. Now, for those of you who've been with Unit21 for a while, you might be using what we call scenario models today. But we also, for those of you who might not be so familiar, we also have the dynamic model builder, what we call the DMB, which I will showcase today how you can potentially use to detect this type of financial fraud activity. So, for example, on the top, on the bottom left side of the screen, you can actually see an image I took this morning from an illegal market that shows us that a check is being offered for sale. So you can buy this check today for $1,400, and the value on the check is $12,000, and it's from September 6th. So the check has recently been stolen. It's worth more than $12,000. You can go on an illegal market today and buy it for $400. This is a very simple example of how those markets operate. But really what we want to achieve with the dynamic model builder is we want to think about all the different vectors that we want to take into consideration when we want to gauge how the activity of this account been so far, right? So if you're not familiar with the dynamic model builder, the screen really has two sides to it. So on the left side, you have all the variables that you will define. And on the right side, you have the trigger conditions, basically how we use those variables that we predefine in order to trigger a specific scenario. So in this case, I created an example rule that will flag the following. It will say the next. So if in today's day, on this business day, we have more than $5,000 worth of mobile check deposit, which in this case, it's a $12,000, so it checks out. And then it goes into a drill down of the previous historical activity I described a couple of minutes ago. So one thing we're doing here is we're saying, if the amount that was deposited today is 200% higher than the average payroll that this person received in the past 3 months. So for example, if somebody does make a payroll deposit and we expect a certain amount of salary from that person every 2 weeks, every month, depend on the cadence they get money. But the check they deposit today is 200% or more higher than the average deposit that they make. And that the check they made today is 100%, 150% higher than the average check they deposit in the past 3 months. And they have an RDI count of bigger than 2 in the past 3 months. So they have at least 2 checks who bounced or returned in the past 3 months. And the count of the return checks against all the deposited checks is 50%. So basically, half the check they deposited in the past 3 months are returning, And then we go into non-transactional conditions. So we might say, and this account age is less than 100 days. Okay, so this account has been open only for 3 months. And we get some insights from maybe our KYC vendor, our email risk vendor that says, the email risk score associated with this account is 90 or more. As this is a very, very basic example on how to take different historical activities of this specific account and try to understand whether or not the check that is being deposited today is out of pattern, it's potentially high risk, and we might suspect that it might bounce. If all those conditions are met, alert will be generated. And once the alert is generated, the agent basically has all the information in front of them, and they can decide whether or not they want to accept, they want to decline the check, maybe they want to put an extended hold on the check just to make sure it doesn't return. But basically, our goal with Unit21 is help the agent to make the best possible decision in the shortest amount of time. And I think using the DMB is a great tool because you can really drill down to the specifics of how fraud is trending on your platform and use as many variables as you want here pretty much to make your rule really hit the target each and every time. So for the second scenario we are seeing a lot lately is what we call a fake employment scams. And basically with a fake employment scam, what we're seeing is that people who are targeted are people who are looking for a new job. And people who are looking for a new job is usually an easy target for fraudsters because sometimes people don't have enough emergency funds. They are eager to find a new job, just to keep their family in good state. They have mortgage payments, they need to put food on the table, they need to provide for the family. So a lot of times they ignore many red flags that a person who may be not in a rush to get a new job will do. And I get this question a lot of our customers ask me, well, Alex, how we can detect scams? And usually my answer is that each scam has a story. And if you can tell that story and turn it into historical activity, you can potentially detect the scam. So here is an example of how we try to detect potential employment scams. So with employment scam, the very, very basic of it is that the person who is the victim, who is targeted, is being offered a job. And once they accept the contract, the next thing the fake recruiter will tell them, well, you need some equipment to do the job. You need to buy a computer, you need to buy maybe a monitor, keyboard, whatever that might be. We will give you a check. We'll write you a check to buy this equipment. But don't go to Best Buy, don't go to all those retail stores, don't go to Target, don't go anywhere to buy it. We will have a dedicated person who can send you the whole package, and it will be much cheaper, and it will be within the budget that we set for you on the check that we wrote for you. So basically, they will encourage the person to deposit a check to their personal account, and then to P2P, the same amount or slightly smaller amount to a third party, which is supposed to be that vendor who will provide all the equipment that they need to do the job. And the way we go about it in detecting fake employment scam is we create a rule in the DMB environment, and we say the following. We have 3 variables here. So we will say, okay, what is the check that is being deposited today? And like in the previous example, let's say it's $5,000. We will say, what is the amount of the P2P transactions that we've seen in the past hour? And we will count how many payrolls this person received in the past 2 months. So if, for example, we know that this person used to get payroll twice a month, it means that we expect by default, if that person is still employed, to have at least 4 payrolls in the previous 2 months. So we say one of the conditions is if there's less than one payroll in the past 2 months. So chances are this person not receiving payroll anymore, which means they are maybe unemployed. And then we say if the check that they deposited is higher than $5,000, for example, and they already took out more than 80% of it via P2P in the past hour, then generate an alert. So this is just an example of how you can think about a scam, translate it into a story, and then if you can translate the story into historical activity, you can go and define the right variables and trigger conditions to actually alert on a potential employment scheme. And for the third scenario on mobile check deposit fraud, we will discuss very traditional funneling of funds. So basically, with funneling of funds, we talk about multiple deposits which are shortly transferred to different accounts. And when we try to find those funneling activities, we usually try to see if the activity is even matches to what we expect from the account to behave based on the CDD or CIP we did when we onboarded the account. We try to gauge what is the risk profile of the account, and we play with inbound and outbound velocities to try potentially capture something like this. And an example for DMB rule can be the following. So let's say when we onboarded the specific entity, when we onboarded the user, we made some risk assessment, and we came to a conclusion that the value of the risk is 80, right, which will be considered probably high. What we can do is we can play with the inbound outbound velocity. So we will say if the outbound in the past 7 days divided by the inbound in the past 7 days is more than 80%, which means they already took out at least 80% of the funds they brought in the past week, and the total inbound is more than $10,000, we can generate an alert. But this is very general, right? When you do analysis and you look for funneling and you look for money mules in general, try to understand which ways are more lucrative for bad actors to use your accounts to take the money out, where you have more flexibility, where you have higher limits, higher thresholds. So you might say something, if it's 80% in general of $10,000, or maybe if it's 50% when the outbound is cash, or maybe it's 50% when the outbound is a P2P transfer. So you can be more sensitive with your thresholds based on the outbound channel and the money and the type of the money movement. So again, very simple example. Obviously, you can go and be way more sophisticated with that, adding more entity level categorization here to be very specific about who you want to target with this type of rule. But again, it just showcases how flexible and powerful our dynamic model builder is. So if you're not using it today, if you're still using scenarios, I encourage you to start considering using the DMB. If you are using the DMB but have some questions on how to fully utilize the powers of the DMB, feel free reaching out to your customer success manager, and we are always more than happy to help you achieve your goals. All right, so let's move to our second fraud that we will discuss today is card not present fraud. And with card not present fraud, we see a high spike across all our customers who issue either debit cards or credit cards. And honestly, it's not really surprising. I think since the introduction of chips in EMV transactions, over the years, we see less and less card present fraud. We see less counterfeit cards out there on the market. But card not present fraud is on a rise, and it's on a rise for two simple reasons. First of all, the data breaches that we see today are on much higher scale, which means each data breach, the bad actors are able to get their hands on way more cards. But not only data breaches, we have a lot of botnets today that pretty much infect computers, and when computer is infected, it will get all the payment methods associated or saved on that computer. So this is another vector. But also, what is surprising that it became very cheap. So it used to be slightly more expensive to buy card numbers on those illegal forums, and now it's very cheap. You can on some forums even buy a card number with a validation and a CVV for $2, which is in any case great ROI. But basically, what we are seeing among our customers is they utilize a lot of historical behavior when they try to detect card not present fraud. So basically, in Unit21, there is no need for you to profile your customers. I know that some of you come or transition from a legacy solutions where you need to build those profiles, and then you need to look up those profiles each time you reference to historical data. But in Unit21, there is no need for you to do that, just like I showcased with the DMB. You can just define the variable and query against the variable each and every time. And if you know how to define this historical behavior of your customers, it's pretty easy to detect anomalies. So this is a very basic transaction monitoring practice, but we see it across all our customers. The second part is high-risk MCC codes. Now, one of the things our machine learning team is doing is they conducting investigation on all the rules that are associated with card transactions, and they provide us insights across all of our customers, so pretty much industry insights on what are the MCC codes that are associated with the highest rates of true positive disposition of the alerts. If you don't have that list, if you're a Unit21 customer and you don't have access to that list, please reach out to your customer success manager. They have it available, and they'd be more than happy to provide those MCC codes to you. But then you can pretty much define what is the risk you're willing to take on each and every MCC code, and create your thresholds accordingly. The third part, and this comes for more analytical customers, is that even though this practice is it's very considered old school, but they do conduct a CPP investigation, and they try to understand where the cards were compromised. And when they understand where the card were compromised, and in order to do that, you need probably 2 or 3 cards at least that's being utilized by the same fraud ring. But once you understand where those cards has been compromised, then you understand the date, the range of date that impacts that specific merchant or business that was breached. You can go and query and see, okay, how many of my cardholders actually transacted with that merchant? How many of my cardholders might be impacted? And then as a preventative measure, you can go and just reissue new cards to all those potentially impacted users. Now, reissuing a card might cost you $1 or $5, but I think it's in general good investment because an average fraud loss ticket we see today is around $67. Obviously, if the numbers of exposed cards are very, very high, then there's other measures you can have in place, like real-time monitoring, which we will discuss now. But overall, don't neglect that very old school practice, and try to see if you can find the common purchase place for your exposed cards, and go and be proactive about replacing potentially impacted users who haven't been impacted yet by fraud. Now, when we circle back to real-time monitoring, for those of you who've been with Unit21 for a while, you know that our rule engine is asynchronous, so you can run rules as fast as every 10 minutes. But we also introduced earlier this year our real-time API. Now, our real-time API is specifically designed for users who work with real-time or near real-time payment rails, such as cards, such as maybe the FedNow, the RTPs. But basically, it allows you to get a response from Unit21 with less than 250 milliseconds, whether or not you should approve or decline specific transactions based on the criteria that you define within a rule. And then you can take that response and you can plug it to your authorization flow and pretty much decide if you want to decline the transaction or not. If you're considering real-time fraud strategy, you need to understand pretty much what is your appetite and how much transactions you're actually willing to decline to save X amount of fraud. If you want to brainstorm together or you need our expertise that help you define what is the right number, what is the right threshold for you, please free to reach out. But also it's important to remember that if you decide to go to real-time monitoring and real-time declining, the decline is only the first step. So you really want to think from operational perspective, how you create a very frictionless experience. A simple example would be if you decide to decline a transaction that ends up as a false positive decline, you need to have a very easy and prompt communication with your cardholder. So you need to notify them that they've been declined, and you need to give them some action items of what they can do about it. So it can be something as simple as a text message when they will reply yes or no if they did the transaction, and then you can white label them or block their card based on their response. But you make sure that before you go and switch to real-time API, you have this workflow figured out, because it's very, very important for your customer experience to have a good experience when you actually go and decline them when they're at the register. And for the third topic that we have today, something that keeps a lot of our customers busy is really money mules and drop accounts. I have here some screenshots of offerings that different vendors have on illegal markets, and basically you can see that it's a pretty lucrative business. Like, for example, this seller right here. He tells you something very simple. He basically tries to recruit you to be a money mule for them. So he says, if you got a Wells Fargo, a Coinbase, a CD, PNC, or whatever, I will deposit $40,000 in your account. And once you withdraw that money, we can split 50-50. So all you need to do is, connect them directly, some basic introductions. You will provide your account number, routing number, maybe additional information, depends on the seller, and then they will go and deposit 40K into your account, which you can try, go and withdraw, and then split 50-50 with the seller. Other sellers provide drop accounts. So basically they tell you for $100 you can buy an account with $1,000 of worth of balance, right? And for $500, I will give you access to account worth of $5,000. And it goes on pretty much any payment platform that you can think of. So with money mules, first of all, what's important is how internally you define a money mule. What money movements are not correlated with the way you expect the user to use your product. And once you set those thresholds, you can start monitoring inbound and outbound activities. But who are we really trying to catch? Are we trying to catch the seller, or are we trying to catch the buyer? That's questions I've been asked quite frequently. And I think it's both, right? Because although we put it under one category, is drop accounts and money mules, there's different stages to where we can potentially go and capture and understand how to identify those accounts, right? At account creation, many of those sellers on the market, they use either synthetic or compromised identities. Obviously, they're not opening accounts in their names. So it's important to understand during your onboarding process, during your KYC process, what insights you can collect from either your KYC vendor, from the way that data is being presented to you during onboarding, whether or not that entity might be synthetic or just a compromised entity. The other stage is on the deposit side of things. So for that scenario, when they offer to sell an account with available balance on it, it's one or the other. It's either it's a account that has been dormant, so it's been sitting for a while already with the money, or it's a brand new account that has no money in, so they will make a deposit and then they will sell the account. So for the first scenario, you probably want to define what is dormancy to you, and when you consider an account to be in dormant, and then monitor those accounts, what happened with them. For the second scenario, you probably need a good understanding of what you expect from a brand new user, what you expect the first deposit or maybe the first 2-3 deposits to look like, and start monitoring those. Obviously, it's much harder to do on scale when it's a small value like $1,000. Much easier if it's 5 or it's 10 or 40 like here. But it's all about velocities. It's all about the game that you play, whether or not it's worth your time. And the second and the third and last part is if we're catching the buyer, we usually will see one or the other. So if somebody gets access to this account, try to distinguish how this account has been accessed before by the seller and what is different about the account being accessed right now by the buyer. Different IPs, different devices, different way of if you use biometrics, different way they type the password to the account. So try to distinguish if you do have account that it might be dormant with let's say $5,000 balance in it, and now it's being accessed in a slightly different way than what you used to see. Maybe it used to be accessed from a computer and now it's accessed from a mobile platform or vice versa. There's many insights you can collect and potentially flag and freeze the account and make sure that whatever is happening is really legit. But there's certain ways you can catch the buyer before they cash out, before they take the money out of the account. So that's the three fraud types I have for you today for this session. And now we will transfer to the Q&A part of this call. And let's see, I have some questions right here. Okay, so one question we have from the audience is for organizations who just starting out developing their fraud or anti-money laundering strategies and rules, is there specific data you recommend utilizing from the beginning? What specific data is needed for rules covered today? Great question. So we are great believers in Unit21 that you can utilize both transactional data and non-transactional data to create a very sophisticated set of rules. Obviously, when you implement Unit21, we will ask you to send us the data about your entities, which means the user, and the data about the transactions. So how those users make transactions on your platform. This is very basic concept, right? But I think for non-transactional data, I really like seeing users, companies in Unit21 who utilize action being taken on a platform by the user. So for example, if we can get the login session, and from the login session, we can get the IP and the device fingerprint. And then when they go on the app or on the web, what are they doing that is non-transactional? So are they adding a new PAI to the account? Are they adding maybe a new email? Are they changing the primary email? Are they ordering checkbooks? Are they changing PIN codes? So what are they doing that potentially indicate that there is a fraudster accessing the account and not the user itself? So definitely those data insights. I also really like when customers send us third-party data from vendors they already use. Now, if you spoke to me before, you know that I believe that there is no one fraud solution for you out there. Usually what we see with forward-looking customers is that they will have an orchestration platform, and they will plug in either 4 or 5 different point solutions that specifically answer the needs of their business. So it can be, email risk vendor, device risk vendor. If you in the crypto space, then they will use something like TRM or chain analysis. So know your transaction better. When you start plugging in those vendors into Unit21, you can be very more sophisticated and very pinpoint which population you want to target with your rules. So definitely bring more data from KYC or from your on-chain monitoring. But basically, there's no limit to it. It really depends on the type of business that you have, how you operate, where's the biggest risk associated with your business. And we are very data agnostic. We're very proud of it. We can ingest any type of data you will send us. Let's see, another question. Is there difference in variables and how they're set up in rules depending on whether it's a small business or large organizations? Absolutely. I think when you build a rule and when you test a rule, and one of the things we do offer in Unit21 is the validation mode, which allows you to gauge what is the potential impact of this rule going live on your team. It's definitely makes sense that you cannot have the same thresholds for large enterprise organization and for a small startup that's just getting started. From operational perspective, obviously, the more users you have, the more transactions they have, the more volume you see, the more fraud you will see. So the more alerts you will generate. But also, if we take a little sidetrack about anti-money laundering, you cannot expect a small, let's say, neobank and a tier 1 bank to file the same amount of SARs every month, because obviously the volumes are different. So absolutely, it makes a lot of sense to gauge whether a specific threshold is right for you, both from operational perspective, but also from compliance perspective. The other part is, and we will talk about it in the next session next month, is how you do optimization. So we show you all the rules, we show you all the ways you can be creative with those rules, but you also need to keep track on those rules and how they perform. And the next session next month and the end of October will be exactly about that. How do you deploy the right rules? How do you monitor? And how do you know whether a rule is healthy or in not healthy state? Maybe it's time to retire a rule. We will touch upon that next month in session number 2 on this series. And I think this is what we have today. Let me see if we have more questions. Yes, I think that's it. So that is the first session. I hope you find it educational and it benefits you. Again, if you're a customer, feel free to reach out to your CSM and ask more questions if you feel more comfortable. If you are a prospective customer, please reach out to your point of contact at Unit21, and we can continue the conversation about how Unit21 can serve your needs. I will see you again next month in session number 2. Thank you so much for your time. Thank you so much for joining me today. See you next month.